Everybody, welcome to this episode of the Note Closure Show. As always, Scott Carson, jacked up to have you here today. And with it being the new year, I thought we would start kind of things off with somebody who's making a big bam in the industry. Somebody who's done just about a billion B for $1 billion in roughly in real estate. This lady has done it all. She's got her hands in the proverbial multiple real estate pies, from single family to multifamily to car washes to assisted living. She is self storage. She's also done about 5 million in residential real estate flips, and somebody who's got a new book coming out by Bigger Pockets here in just a few weeks. And so, who are we talking about? Well, we're talking about the rock star, the host of the passive investing, passiveinvesting.com. She's the director of investor education there. And then she's, like I said, just she's a bestseller out, Resilient Women in Life and Business. Just an amazing person. Who am I talking about? Well, if you don't know who Whitney Elkins-Hutton is, then you definitely want to take some notes and tune in today's episode. Whitney, we are honored to have you here on the Note Closure Show today. How are you doing today?
I'm doing great. Thank you so much.
You're welcome. You're welcome. It's been a bit of a busy year for you.
Oh, slightly, very slightly.
I know.
It's been busy, not busy.
Yeah, exactly. It's always good to be busy, and it's funny. We both know, you know, Dan pretty well. I know Dan pretty well too, back Dan Hafford and stuff like that. But kind of, can you share with folks a little bit kind of about how you got interested? I know you've done a lot of stuff yourself, but you're also part of multifamily investor nation and stuff like that going on there. But how did you kind of get started into what you're doing, and talk about your journey a little bit there?
Yeah, absolutely. Well, thank you again for having me on. I am the director of investor education at passiveinvesting.com. We focus on multifamily, self-storage, and express car wash private equity. And then we also have our real estate debt fund. Our main thesis is helping investors invest for cash flow, equity growth, capital preservation, and then also balance tax benefits. I didn't start off, I don't have a degree, a business degree, or, I didn't go to school for real estate. Matter of fact, I went to school for public health. But yeah, my real estate journey really started back in 2002 completely by accident. I, bought a house with a significant other, and about a month later, the relationship fell apart and everything was under my name. The house, the utilities, everything. So I panicked slightly and stuffed it full of roommates. And also, this house was in a dire need of a rehab. And long story short, I paid my friends in sushi, beer, pizza, and got the Home Depot 1, 2, 3 book. Guys, YouTube did not exist back in 2002. There was no like Googling videos at night, like how do you like put together drywall? Like, no, that didn't exist. I had to learn everything from a book and put the house back together, sold it 11 months later. And then that's when it dawned on me, not only did I get a healthy paycheck at the closing table, as far as capital gains, but that's when I was like, oh, wait, I haven't been paying for any of my housing expenses, mortgage, utilities, nothing like that for 11 months. And I'm like, ooh, how many more of these projects could I possibly do? And so, to take a very long story, 22-year journey and compress it into about a minute, and did several more of these live-in flips and house hacks individually, and then also with my husband. And then it dawned on us that we were good at building equity, but really bad at building cash flow. And then one of our friends was like, well, why don't you rent out the property? We're like, oh, genius idea. So we started in Colorado buying single family homes, realized they didn't cash flow. It was going to take us forever to hit our financial numbers that we wanted to hit. So we started investing out of state and scaled 36 single family rentals, still doing several flips on the side to replenish our capital. But then we hit our next ceiling of achievement. We had our baby girl at home, and I was taking care of some family members at a distance, and it's still working. And so we had to scale and go further faster. So that's when I forayed into multifamily real estate, and then was general partner on several deals, and then really realized what I wanted from real estate wasn't actually to be in real estate. What I wanted was the cash flow, the growth, the freedom that it gives you. So I wanted choice on how I spend my time. And that's what I get to do today. I'm super excited. I feel like I've done so many things in private equity real estate, but where I'm at today is helping investors understand what private equity investment is, how it can be a part of their portfolio, and just really how it can really amplify their goals as, whether they're in active real estate or totally passive, and how it can help them achieve those 5 freedoms in life.
Mm-hmm. Now I got to ask a question. There's 36 rentals that you had out of state. Where were they located?
Yeah, several of them, probably like 6 or 7 of them were in Indianapolis area, and then the other bulk of them were in Kansas City metro
Okay.
area.
Yeah, not bad. Great. Yeah. Fast evictions, 14 days in Indy if somebody's not paying, which is also really nice. And we like to invest those two areas for the debt side of things. But let's talk a little about private equity. When somebody's hearing that for the first time, they may think it's one thing. What's your definition of that?
Yeah, so really what we're focused on here at passiveinvesting.com is group investment. So we work largely with retail investors. So, if you're listening to this, you have a job, you're probably like, could qualify as a retail investor. So we're not working with large REITs or insurance companies or institutional money. We're working with the everyday person who has a higher and better use for their time. Maybe they're a high tech income tech worker or a doctor or a lawyer or a business owner, and they want to be invested in real estate, but they don't have the time to figure this all out on their own. Or even if they figured it out on their own, they're like, man, I don't have the time to scale. Like I got other things that I need to do. So they can still get all the advantages of real estate, but real estate by coming together and investing as a group to take down, like, right now we have an $82 million project, multifamily project that we are raising capital for. So we're bringing hundreds of investors together in order to bring down this property or invest in this property.
You've been doing this for a while. Have you guys seen the market change a little bit with interest rates increasing and projects? I've started to see a lot of distressed debt. Not saying your guys' stuff is, but you see people that really overpaid or didn't finance things properly back in the day. I think that I know there's opportunity in that. And are you starting to see some of those opportunities come across your desk and stuff like that for projects?
Yeah. So, has the first part of the question, has the market changed? Absolutely. Right. Back in 2017, 18, 16, 17, and 18, everybody looked like a genius. Money was cheap. Equity was, easy, like shooting fish in a barrel to capture on a property. About 2019, that's whenever we started seeing, I wouldn't say cracks, but the market starting to shift, right? Especially in multifamily real estate, the values started topping out. And so, you could have a value add project, much like a rehab project on a single family property, and a class A property that needed no rehab. They were trading at almost the same cap rate. And so we saw an immense amount of cap rate compression there. And then, we experienced a few bumps in there, one of them called COVID. And
Yep.
then, when you inject that much money into the monetary system, you have more money chasing the exact same amount of product and possibly even less product. So that's why inflation occurs. Like we see the cost go up. So we saw rampant appreciation on properties, which is fantastic if you were able to sell or reposition your property in late 2020, early 2021, and maybe into end of 2021. And then the tide started shifting. The Federal Reserve said, okay, great. We're coming out of the pandemic. We need to start pulling back some of these dollars out of the monetary system. Well, how do they do that? One of the ways that they do that quantitative tightening now is through raising interest rates. And that's when you really started to see the cracks. Which of these operators during that exuberance had overpaid for property, over leveraged themselves? Maybe we're using adjustable rate loans, didn't put a rate cap on them. And so we really started to see a lot of cracks in the systems. And that's, what we've been struggling with for the better part of like a year. I remember sitting on a phone call, Paul Sloat with, I'm going to butcher his company name, Green Drake Advisors. Mm-hmm. I'm not endorsing him by any stretch of the imagination, but I remember I'm part of a mastermind group where he's in there. And it was right after the war with Ukraine broke out. And he did this whole webinar on like, what does this war in Eastern Europe mean for us here in the United States? And I remember sitting here on this call and he was like, we're going to see rampant inflation. We're going to see interest rates rise like they've never before, as quickly as they did in the 1970s. Guys, hang on for this ride. And I'm like, this guy's nuts. No way. And guess what? Right? This is, are we at 13, 14, 15% rates? No. But, that trajectory was there, right?
Yes.
Like, we saw, things go from, essentially 0% lending. Now it's 7% as your base rate. Like, holy cow, that's huge.
Yeah, it's definitely a big difference in taking a hit to your cash flow and pricing. It literally affects everything. And then, of course, repair costs, goods, cost of goods to go in and regentrify a project or rehab it versus walking something that's cash flowing. Definitely a big difference out there in a variety of things. We see that too on the debt side. With the higher interest rate, that's actually a little better for us. On the mortgage investing side, low interest rates. We weren't buying a lot of those low interest rates because for us to buy them, we had to buy them at a huge discount. But it's definitely, you've got to keep your eye in the markets, and you got to really kind of stress test your deals before pulling the trigger on them a lot of times too, right, Whitney?
Oh, absolutely. I mean, I have a single short-term and term rental property, and I'm actually, probably 6 months late getting it listed and trying to get it sold. However, I stress tested my cash flow. I knew how far my rents on that property could drop, and I still break even on the property. So, the property is still viable, and we actually have built-in equity gains. A lot of things are working well for us, but a lot of people don't have that position, right? They couldn't afford to take a 30% haircut on their rents. They couldn't afford to have that amount of competition enter the
Right.
environment all at the same time. They can't wade through like some, especially like with short-term rentals, all of the legal changes that are happening, licensure, stuff like that. So we're seeing essentially, what is the quote? Like, when the tide goes out, you figure out who's swimming naked, right? So
Mm-hmm.
we're seeing a lot of this happening, right? There's a perfect storm that's converging. You got high interest rates, you got low cash flow, and then you have high inflation on top of that. And so asset prices aren't coming down like they should be. We're just now starting to kind of see the crack in that system. So yeah, this is, really a really challenging time for people. However, this is what, in being in the note business, this is why lenders underwrite cash reserves. This is why everybody should have ample reserves, so they don't have to sell an asset during this time. They can hold on to that asset and get to the other side of the situation.
And that's the biggest thing is, people don't often realize and that's the thing is, so many people, when the market's going up, everybody can make money. I mean, you could literally be a blind squirrel and get it right half the time. When things are going up, it's when that market changes and you have a downturn, it really separates those that have the systems, the stress tests, who's been around for a period or two, to understand that, hey, just because it's good now doesn't mean it's always going to be that way. We see that in a lot of different areas. I remember being on calls with mortgage brokers and bankers. I'm like, listen, the things I'm seeing happen now took place back in 2007, 2008, and some other things. That things are going to change here. You need to be like putting some money aside, stocking some reserves aside, because when that market turns, there's going to be a whole lot of realtors, a whole lot of mortgage brokers out of work. And sure enough, that's what happened. And you also had a lot of investors that, like, oh my gosh, this isn't as easy as it makes it out to be, like that YouTube video or those HGTV shows thing to be. You know what I mean? I'm like, come on now.
Well, I mean, two things really like stand out to me there. I know whenever I was, in the middle of my fix and flipping days, I could have like 4 or 5 projects going in my name and in my husband's name. And, the lender saw our reserves. We were able to demonstrate reserves. And here's the thing, it was the same pile of reserves for all of those properties. Yep. Right. And so, yes, I was able to, check that box with the lender, but like, if I had to tap into those reserves across all of those properties, like that would, I don't, there were several times that I was like, I don't think I can do that. Now I've taken a much more conservative approach, set aside, any project we do, we're setting aside, a year's worth of expenses, all of our insurance deductibles. And, again, now I'm creating quote unquote drag in my portfolio, but you know what? I get to sleep well at night. Also, guess what? I have a war chest of money for times like these. Like we could go buy assets right now. We could take advantage, I hate saying the word take advantage, but we can, see the opportunity in today's environment and create win-win situations for people.
I don't think it's bad of taking advantage. I think you feel bad because you're taking advantage. You might be taking somebody's downfall along the case. I think it's the being able to act quickly, being agile, mobile, and hostile, maybe a little bit to make some things happen. But that's when that's the thing is there'll be more wealth created now in the downturn than there was in the upturn if you know how to act and you have that war chest ready, that dry powder sitting on the sidelines ready to act upon a deal on a price. Probably not going to see some prices like you haven't seen on stuff in quite a few years because things are looking at. I got an email from a bank the other day on a 250 unit multifamily that the borrower is 110 days late, but the bank's already foreclosing. The bank is literally, instead of trying to work it out, they're like, we're going to go ahead and foreclose. I'm like, man, most of these banks were like kicking the can down the road of trying to make things work. I'm like, that's a surprise turn in the market in a lot of cases that.
Well, we have our preferred equity fund open, and I will tell you, in that fund, what we're looking to do is help multifamily operators, for anybody listening here, what we're helping them do is, if they have a high quality asset that is the NOI is still there, right? It has to still be performing, but really what they lack is the ability to either refinance the property to get better rate terms or debt terms, or, purchase that next interest rate cap. That's what this fund is designed for. Well, one, it's been challenging to, find quality properties. There's a lot of, properties that are not performing because the NOI has decreased on them. Either they're not able to achieve their rent increases, or in some cases, the vacancy has actually expanded or the occupancy has actually dropped. But there's a handful of properties that actually do check all the boxes, except for one thing: the lender. The current lender on that property is challenging to work with. We are, looking to work with lenders that understand, that it's not in their best interest to take back a 252 unit property. Like, what do they know about operating a property?
Amen to that, sister. Amen to that. Yeah, they're the note space, not the operation space.
Yeah. So, but that is on our due diligence list, right? And it's the only way that we can help, preserve our investors' capital, because I would say it's few and far between, but there are lenders out there like that I don't see the benefit to their balance sheet by doing that, but I don't know all the specifics of the particular scenario you put out there, but I can't. That I would think that's a lesson that we all learned in 2008, 9, and 11, right? Like lenders don't need to have all that on their balance sheet.
Well, that's the biggest thing too. If it's and it could be that they've worked with the borrower already in a variety of fashions, and maybe they just realize that there's no reserves and what's going on too. But I was just very surprised seeing that from that lender. Of like, that's kind of surprising. I mean,
just a little over 3 months and they're going to foreclose, right?
Yeah, I mean, literally, they were calling for bids to start coming in off of that, and I was just like, that just doesn't make any sense. But you're going to end up owning it. If you think you're going to sell it at the auction, that's great, but you're probably going to take it back, and then management's going to struggle. You're going to have probably increased occupancy, which drops your NOI, and then you're not going to be sitting very good at all. One of the things we have seen is more lenders when you talk to somebody there that understands versus just a regular person, isn't on their job title is not on the line, just put there, versus just like a loan officer and asset manager. Is that if you come with a creative situation or work with a bank and you really get it to go up the line, either to the loan committee or like that, I've seen some amazing things happen. Especially we saw a lot happen back in 2008, 9, and 10 but
Yeah.
started to see that, hey, they're starting to waken up that, hey, we need to get creative here versus just being black and white on the deal scenario, you know?
Mhm.
And it makes for an opportunity for funds like what you guys are working on.
Yeah, absolutely. Yeah. I mean, distress is going to happen, right? I mean, there's no way around that, because not everybody, like, even on the operator side of things, not all operators are really, even today, fully understanding what they need to do in order to reposition their asset. And there's so many things that they can do, like engage like a fund like ours before they have to like do capital calls or even hand the keys back over, right? There's like a, 6 item punch list that they can do. But
Right.
some operators are trying to hold on for dear life, and that may not be the best situation for them either.
Well, and that's the thing too, is when you're in a stressed situation like that, you don't think right in a lot of cases.
Mm-hmm.
Your
I would
ego
agree.
gets in the way, that can be a killer. Ego can definitely kill. Like, oh, I don't want to look like I'm losing the face here. Well, you need to lose face before you lose everything, on that asset, and work out with folks to figure out some sort of. It may not be a true win-win, but it's a survive and survive in some cases.
Yeah, I heard Johnny Chang with Marcus and Millichamp say, and this was a year ago, almost a year ago, like the survive until 2025.
You know what, I tell you that's so true. I mean, I always find it interesting, because we do a lot of outreach to banks and, hey, what do you have on your books you can get rid of? But it's always interesting. We started to see this 6 months ago, which is I was like, it's going to get interesting. Hang on. When banks are reaching out to me or lenders, hey, what are you buying? I'm like, whoa, you don't return my phone calls, but now you're calling me. You must be really hurting. Of course, looking at their portfolio, I'm like, oh, I see you are hurting.
Hmm.
Let's figure out something. There's still been that big gap, but that gap is getting narrower and narrower by the day. And I really expect us to see more stuff once we get through Christmas here and to get into Q1 of 2024. I think it's going to be I don't want to say a free for all, but if you've got dry powder and you can step up and take on some deals, I think it's going to really lead to make building and creating those relationships now, so that you're on that short call list when the shit hits the fan, like we know it is for a lot of folks. Now,
Absolutely.
now, when you talked about folks out there looking to invest in private equity, let's talk a little about some more of the things that you guys are looking for. Do these folks need to be accredited, sophisticated? What kind of investment amount can they get started with? What are some of those requirements for those that are listening?
Yeah, I mean, if somebody's looking to get, started in private, passive investing or private syndication in general, there's opportunities out there for everybody, like, sophisticated, accredited investors. For us, particularly at passiveinvesting.com, we work with the accredited investor. So, somebody who has $1 million in net worth, either themselves or combined with a spousal partner, and then they have $200,000, income coming in for the past 2 years, reasonable expectations going forward, or $300,000 jointly for the past 2 years, reasonable expectations going forward. So, and there's a couple other, ways that somebody could be accredited, if they have a particular licensure or something like that.
Sure.
But that's, we work largely with the retail investor. And our minimum investments, it depends. Like on our multifamily investments, we tend to do single asset entities. So those minimum investments start at 75,000 and then go up from there, depending on what type of tranche you're trying to access
Right.
in that deal. And then for our self-storage and our express car washes, we acquire small portfolios of assets. It's kind of like buying single family homes or doing notes, right? Like it's just as much work to do one as it is to do 10 at the
Right.
same time. So we close those things, self-storage and express car washes and small portfolios. We have currently a car wash open with 3 assets in it right now. And those investments, since you're immediately diversified over markets and deals, those start at $100,000. And then we have our debt fund too. And that starts at 25K investment.
Very nice. That's a good start. Probably dip their toes in the water and get rock and rolling that way, right?
Mhm.
Now you've got a book coming out here very shortly too. You want to blow your horn a little bit, talk about that, and what folks can expect of that.
Yeah, I'm super excited for this book. I wrote a book in partnership with Bigger Pockets. It's called Money for Tomorrow. sensible guide for building wealth that lasts. And really, in this book, I put in everything with my work that I do at Ashwell with my private consulting clients. But this book is really designed to help anybody, whether they're investing in notes or real estate or business or whatever, understand how to win the wealth game. So if wealth is a game, especially generational wealth, you have to understand the objective, the true objective of the rule, of the game, right? Then you have to understand the rules, right? If anybody's like sat down and tried to play Catan before, or Seven Wonders, or even Monopoly, right? Like you have to understand, like, you're like, great, I can buy property, but why would I do that, right? You
Right.
have to understand the objective and all the rules. And then you have to understand the strategy. So many times, investors I work with are so attached to tactics that they forget that there's a whole rule book out here and there's a whole strategy book. And if they don't have to worry about the tactic, they don't have to worry about the headlines that they're reading. They need to go back to basics.
Mm-hmm.
And so that's what this book is designed to do, is bring people back to basics on how to create wealth, keep wealth, guard it, like don't let it erode. I mean, saving on taxes is great, but that's only one of 6 ways that you can save your money, save your wealth. And I'm not talking about budgeting, guys. And then we talk about how to grow it through real estate, businesses, and the like. And then we talk about how to pass it on. And I'm not talking about wills and trusts. We talk a little bit about that in there, but there's 2 other things that you need to do to ensure that your wealth passes correctly to either your heirs, your beneficiary, or even, maybe it's not money at all, but just the knowledge that you're passing on to the next generation.
Well, that's one thing we definitely need to, because our society is so financially uneducated. And you look at folks that don't understand it, the rules of investing. I mean, and the game that you can play with it, they're just obtuse to it. I'm just like, there's so many opportunities for you to do things, but you got to understand, just 1 plus 1 doesn't always equal 2. Sometimes it equals 3, but you got to figure that out when it applies to that to make things happen. And that's the thing that kind of scares me the most, more than anything else out there, is what's going on and with our generational and what's that next generation hold for us. I mean, I don't want to say this, but that sounds like, hey, we're going to be doing a lot of work and carrying the next couple generations to for out there when it comes to wealth building.
Well, I mean, the old Chinese proverb is, short sleeves to shirt sleeves in 3 generations. One generation builds it, one spends it, and the other one is like, they don't have any, right?
Right.
But this book is meant to sidestep that whole cycle, break that cycle. And it's not about financial knowledge. I mean, that's fantastic, but I wanted to make it actionable, something
Right.
that anybody can do, because it's really about capability, right? Financial, everything that somebody that needs to know in order to become financially independent, financially free, it's out there and probably for free on the internet.
Right.
However, how do you find it? How do you put all those pieces together? Like what's true, what's noise, what applies to you, what doesn't, right? And like I said, this is where I really try to bring people out of the tactics and back to the principles that they need to understand. And then we can, once they understand, the objective, the rules, and the strategy, then we get to have fun. Like, do you want to do notes? Fantastic. Do you want to do like fix and flip real estate? Amazing. Like, do you want to do private syndication? Awesome. Like, but those are all tactics. How do we come back to the principles?
Well, that's the thing. It all starts with good principles. It's like in football. It's all about blocking and tackling. If you can't block and tackle, you're not going to be throwing touchdown passes and dancing in the end zone.
I actually quote George Washington, who's often misquoted. The best offense is a good defense, and actually the quote is the other way around. The best defense is a good offense, right? Like, so, that I can really relate to the sports analogy here.
Sure, definitely. Now, with it being the new year, and obviously book coming out, and that's exciting, definitely exciting, especially when you're partnering up with bigger pockets for that. But what are 2 or 3 things out there that you're looking for or keeping an eye on as for your investment strategy? Things that you're, keeping an eye out, looking for, or maybe things you've tweaked up a little bit depending on what goes on in the market in the next 6 months.
Yeah, I mean, really, it's the same thing that I've been, the same journey that I've been on for like the past, like probably 3 years, honestly, but definitely really been paying attention to it for the last year. It's the operator. right? Like if I'm going to invest passively in the asset, or if I'm going to do it actively, you have to be knowledgeable. You have to be the expert. You have to be the expert in the strategy. You have to be the expert in the asset class. You have to know how to surround yourself with experts. So, for passive investment, it's all about the operator. It's the jockey riding that horse. And I've had operators, I do a lot of investing on passiveinvesting.com. I mean, it's my home turf, but also like I diversify my portfolio too with other operators because as a passive investor, I can, diversify operator, market, and deal, right?
Mm-hmm.
That's really all I can control. But I feel like the last 3 years, all of my operators essentially how they've handled the environment. They've been re-interviewing for their position in my portfolio.
Yeah.
And I really encourage everybody to think like that. Two, I'm paying attention to the debt markets. What's happening in the debt market? How can I create opportunity for myself before interest rates start dropping again? And I think it's going to be a while before we see, 0% interest rates, so, but I remember I scaled all of those 36 single family properties. I mean, I think I was holding notes between 5.5% to 7.5%, right? Like even if we see a little nudge down, you can still generate immense wealth.
That's the thing as an ex-mortgage broker, because we ran a mortgage company, we're doing stuff in 30 states. And yes, it's been great to have a 1%, 2% interest rate on a mortgage. Love it. That's great. Free money, basically. You know what I mean? But I laugh when people are like, oh, the sky's a falling. I got a 6% interest rate. I'm like, that was pretty good back in 2007, 2008. I mean, it wasn't, it's great. But yes, you can cash flow. You just got to adjust your numbers a little bit and tweak what you do. Maybe not over rehab the property, but really look at, it's like you said, a good seaworthy captain was not made in a calm harbor in a lot of cases out
I
there.
love it. Yeah.
I probably butchered the hell out of that quote, but you get what I'm talking about.
I mean, it sounds great to me. Dash Scott Carson.
Yeah, there you go. Exactly. Misquoted blank blank. Anyway, but I mean, you're so right about that. Is that I mean, we're expecting to see some rates increases based on what the Fed's doing a little bit there. Hopefully, we don't see a run up on there. The markets are it's always interesting when the Dow's up or the Dow's down, and especially with what's going on overseas with is the war still going to be going on there? Are we getting to another one? It's just it's a chaotic world. And the best thing you can do is understand the operator, understand the asset class. Is one of my best advice I can give you is understand what you're investing in first and foremost.
Absolutely.
Get educated on it. Doesn't mean you need to be the one pulling the trigger, but that way the person pulling the trigger knows exactly what they're doing and not being the blind mice down the road there in a lot of cases.
Yeah, hope is not a strategy. And that is a huge thing that I see investors do. Like if there was an investing mistake, I mean, to piggyback on what you said, I mean, not understanding what they're investing in, but hey, my buddy invested in private equity and he likes that guy. I'm going to invest along with him.
Yeah.
That is a great formula for losing money.
Yeah, exactly. And you've seen a lot of that. We've seen a lot of that out there. Definitely. Oh, it's just going to be great and this and no research. And then hey, that's just like gambling. You might as well go on over to Vegas and put everything on the black or red and on the roulette wheel and see what's going on with that. So what days does the book come out again, Whitney?
February 22nd.
February 22nd. There you go. You can pre-order this now, guys. Maybe make it a great little late Valentine's gift for your loved one or loved ones. They can fall in love with real estate investing by reading Whitney's book out there for you. So what's the best way for our listeners and audience out there to connect with you, to follow with you, Whitney, see what all the good things that you're up to?
Yeah, absolutely. If you're interested in passive investing, you can reach out to me at passiveinvestingwithwhitney.com. And if you're on this financial journey, just starting out or want to actually fortify your, be the best investor that you possibly can, fortify your situation, you can reach out to me at ashwealth.com, ashwealth.com.
Awesome. Good stuff. Well, thank you so much for coming on and share your time. We look forward to your continued success and looking for that book to turn into another bestseller for you there.
Awesome. Thank you so much, Scott.
Thank you. All right, guys and gals, take Whitney up on that opportunity. Get that book ordered today. It's a great way for you to learn, share the love, share the knowledge, because that's one of the best ways to is to help your fellow man, human out there. Maybe you know somebody around the water cooler or somebody that wants to get started. This is a great way to get things rocking and rolling for you. So go out, take some action, everybody, and we'll see you all at the top.